Good morning. My name is Deborah Fuhr. I'm the managing partner and founder of ETFGI, an independent research and consulting firm based in London. We are doing independent research, monthly reports on trends in the ETF industry, looking at it by region, countries. We also look at what's happening within ESG, smart beta, crypto, thematics, all the different types of products that are out there. We make a fact sheet for every ETF every month. We also have a directory of all products. We do events, and we also do a TV show called ETF TV. And I'm one of the founders of Women ETFs, which actually now is also active in India. The idea is to connect, support, inspire women and diversity in the ETF industry. We do embrace and want men also to be members because it's very important to have them as allies. With that, I'll talk a little bit about the topic for today's presentation. So, embracing change and adaptability. What does that really mean? Well, I think you have to think about, at the end of the day, who are products being built for and what do they want and how best to communicate with them. And so at the heart of that is the family. And when we think about that, we really need to think about the husband and wife, the traditional family, or whether it's some other partnership, and the children. And what we do know is that typically women outlive men. If the financial advisor does not have a relationship with the woman, it's more likely than not that she will change financial advisor. It's also true that women's views on investing are slightly different, or sometimes very different than the way men think about investing. And it's also important to think about millennials and Gen Zs because they also have a different view on investing. They tend to be more concerned about investing in things that will have a positive impact on the world. So more ESG, environmental, social, and governance. We also know that this year is a year of a lot of change. Globally, more voters than ever in the history will go to the polls. At least 64 countries, including the European Union, will be going to the polls in 2024. So that is almost half of the population of the world. This will have a significant impact on the economies of many countries for years to come. The other thing that's been important is when we think about what's driving the way people invest, we did notice that during the global financial crisis in 2008, many investors turned to ETFs. They liked the fact that they could get in and out when they wanted to. In general, they're simple, cost efficient, transparent. They could buy them from many firms. So if they had a concern about a particular bank or brokerage firm, that was not going to be an issue. We also know that during COVID-19, this further accelerated the trend towards ETFs. And we also know that there was a significant increase in the number of investors in the financial markets. In the US, we know that 15% of the investors in the market in 2021 were new investors. There's similar numbers around the world in terms of the growth. And we also know that in 2021, ETFs in terms of gathering net new assets, so creations versus redemptions, was the highest ever at $1.3 trillion. So we really saw that COVID-19 and people sitting at home, thinking about finances, spending time thinking about themselves, really made a difference for many investors. So what are ETFs? Just a reminder. ETFs are exchange-traded funds. They are funds regulated like traditional mutual funds, but with the added benefit of being listed and traded on exchange, with a unique creation redemption process. And what that means is ETFs are really as liquid as the underlying securities in them. So if someone wants to put in a large amount of money, what they would do is they would talk to their financial intermediary, say what they want to do, and that organization would decide should they be doing a creation or redemption. And that typically means trading in increments of 50,000. So the ETF would get bigger or smaller. When we think about them, they are funds, as I said, a wrapper. They're not an asset class. So inside of ETFs can be equity, fixed income, commodities. We can also have them be actively managed. They don't have to be index products, just like mutual funds. And ETPs are products that could be notes, partnerships, grant, or trust. And it is important to think about what it is you're buying, because you will find that you're treated with different tax, regulatory, and counterparty treatments depending on the structure of products that you're investing in. When we think about ETFs, they turn 34 years old on March 9th this year. The first ETF was listed in Canada, and it was called TIPS, and it merged with HIPS. The product still exists today, although it is not called that any longer. The US actually came later. So the first ETF in the US on the S&P 500 was launched in January 2022, just 31 years ago. And it is the largest ETF out there. It broke through $500 billion US about 3 weeks ago. And when we think about the S&P 500 index, it is the most popular index. Most investors around the world know that index. And when we look at the ETF industry, which at the end of March had $12.7 trillion, globally, there was $1.8 trillion tracking S&P 500 indices. And then we look at Europe, and we just celebrated the 24th anniversary of the listing of the first ETFs here on April 11th. It's interesting because we also in March celebrated the 100th anniversary of the creation of the first mutual fund. And that was by Mass Financial. And I think what's interesting is that product still exists, and it has about $6.3 billion in it. But about a month ago, Mass Financial also announced that they would be launching their first ETFs. They will be actively managed. So one of the changes we find is even asset managers are adopting changes in the way they think about offering products to clients and in the market. And so increasingly, asset managers are launching at least one or two or three or families of ETFs, and that array is growing, whether it's index or active, partially driven by the fact that in the US, ETFs are more tax efficient than mutual funds. That in-kind creation redemption makes them more tax efficient than a mutual fund that sells securities when there's redemptions, generates capital gains. That process does not happen with ETFs. So where are we with the ETF industry? So we have had 58 months of consecutive net inflows as of the end of March 2024. So we're nearly at 5 years of consecutive net inflows. That is really an impressive number. I mentioned that the assets are 12.7 trillion. We also have had so far at the end of Q1 this year, $397 billion of net inflows, again, creations versus redemptions. That is the highest on record for Q1. The next best would have been $361 billion in 2021, or $305 billion would follow in 2022. When we think about last year, it was a record in terms of assets. So we ended the year last year at $11.6 trillion. And we've seen that global mutual funds last year had net outflows of $651 billion. And when we look at 2022, it was the third best year for ETF assets and net new assets. And when we look at global mutual funds, they had net outflows of 1.1 trillion. In 2021 is the year I mentioned that had the most significant net inflows ever of 1.3 trillion. And the assets ended the year at 10.3. If you look at global mutual funds, that year they had outflows of $36.8 billion. So ETFs have really shown that regardless of the market cycle, they have been able to continually gather net inflows. Part of the reason for that is I did mention how ETFs can be active or they can be index. What we are finding, though, is the majority, 6% is actively managed strategies, and the remaining bit is index strategies. Part of what has driven a lot of investors to move to ETFs is the challenge to find active funds that consistently deliver alpha, whether they're looking at hedge funds, mutual funds or other strategies. And so what you find is the SPIVA study is a good representation, and it illustrates why many people turn to excuse me, ETFs. So if you look at to the left of the middle, it says the US. So last year, 61% of actively managed funds in the US that had the benchmark of the S&P 500 did not beat the benchmark. And on a 3-year basis, 80% did not. And on a 5-year basis, 87% did not. And if you look around the world, these bubbles, you can see that it is hard in almost every geography to find active funds that are able to consistently beat their benchmark. What they recently have put together, which is quite nice, is a fixed income scorecard. And you can see that in a number of geographies, especially in the US, when you look at investment grade or high yield, it is very difficult. Again, 78% did not beat the benchmark, 97% did not, or 68%. So if you're going to spend a lot of time trying to find active funds that consistently beat the benchmark, and you can't do that, it does make sense to use lower cost products like ETFs to be able to develop asset allocation that generates that alpha. So who's using ETFs? Increasingly, it's institutional investors, it's advisors and retail, it's traders, it's portfolio managers, it's fund selectors. Everyone has access to the same toolbox with the same annual cost and small minimum investment size. ETFs being a democratic investment product is really one of the key tenets that has made them an attractive product for investors around the world. I'm not going to focus on all the different ways people are using ETFs, but what I would say is increasingly what we are seeing is large asset managers are building model portfolios. So you're getting the expertise of the largest asset managers in the world building model portfolios. So whether it's different asset allocations with equity and bonds, whether it's tactical asset allocations, there are thousands of model portfolios. And this market in the US for models is trillions of dollars. We are finding that it's growing very significantly. And many financial advisors have decided that the best thing for them to do is use professionally built tools like models that are appropriate for their clients so that they can spend more time doing the things that their clients value them for. So helping them with their taxes, building new client relationships, making sure they know all the clients that they have, the partners, the children, etc. There also are ways that if you just want to do core satellite or sector rotation, you can selectively use ETFs. So this just shows you that growth of the ETF industry, and it also breaks it down by geography. So we do know that the US is still the largest pool of assets, and therefore it represents the largest amount of assets even for the ETF industry. Here you can see that the US accounts on the left side for almost 70% of all the assets. Europe is 15%, Asia Pacific is 6.8%. Japan is significant because we know the Bank of Japan buys ETFs and has held them. So they're over 0.5% of all the assets and account for Japanese assets, 5% of the global market. And on the middle, you can see that 74% of the assets invest in equity exposure, that's indexed. Fixed income is 16%. You can see here active is 6.6%, and then you have commodities and other strategies. Then you can look to see the majority of the money is in market cap strategies. So 64% of the assets, 14% is in smart beta. Many investors do like ETFs for emerging markets. It makes it easy for them to invest. So you can see emerging, you can see China. Thematics is small, but it was very popular during COVID. ESG is really a European phenomena, although we do find sovereign wealth funds and pension funds and other geographies also like it. And crypto has been a hot story this year, especially in the US. So where are the flows going? So far this year, it's primarily been into equities. You can see that for the month of March, we had 94 billion going into equities, 17 billion went into fixed income. If you look at commodities, it had about 1 billion. And you can see active, which has been, as I said, very popular in the US with conversions too, took in 25 billion. And year to date, Q1, you can see that 235 billion has gone into equities. Fixed income has taken in 61, and commodities has actually had net outflows so far this year of 6 billion, and active has taken in 71 billion. And I do, as I mentioned, think we're on a record course for this year in terms of gathering more assets potentially full year than we did even in 2021. So some of the trends we see here is looking at different types of exposures. And so what I'd like to highlight is when we look at smart beta, so that would be things that are factors that over the long run, academic research has shown will deliver outperformance. And so that would be things like size. So small tends to do better than large, higher yielding does better, momentum, quality. So when you look at this, a lot of it is actually in high yield because people are looking for income. And when we look, you can see that there's 1,345 products with $1.6 trillion. And when we look at the Q1 flows, we see that globally there's been 31 billion of net inflows. The US has accounted for most of that, 21 billion. Although if you look at Asia, we've seen 9 go in. If we go to thematics, I think this is interesting because when we look at it, and if we go to all of last year, so far this year, there hasn't been a lot of flows, but I think last year is illustrative of the flows. There was 35 billion going in overall. The majority of it, though, has come out of Asia. So many investors in Asia have like themes a lot more than investors in other geographies. If we went back a couple years during COVID, thematic investing was very popular in the US and also in Europe. And ESG, as I mentioned, is very popular in Europe. So if we look, the 544 billion invested in ESG strategies, 380 sits in products domiciled in Europe. And if you looked at all of last year, the net inflows were 59 billion, 51 was coming out of Europe, and the US had net outflows of nearly 5 billion. ESG has been something that really is not discussed any longer in the US. And then crypto has been a big story in the US with 11 products coming to market. We have seen that Grayscale, which converted their product from a trust structure into an ETF, has up until recently experienced net outflows. BlackRock has taken in the majority of the money, then Fidelity, and then 21 shares in Bitwise with Kathy Wood and Matt being spokespeople that are recognized and seen as someone who knows what's going on in the space, have also taken in significant amount of net inflows. And others have been getting net inflows, but there's clearly 4 that have so far been taking the lion's share. And here you can see actively managed. So globally, about 2,500 products, 838 billion in assets. And you can see the US accounts for 619 billion. Canada is large if you think about it relatively to other categories, and that's because the way ETFs have been regulated in Canada have allowed active strategies to exist since the very beginning. And so they have non-transparent and they have been popular, especially because the banks really control distribution, and most of the banks now have their own ETF families. And you can see that the majority of net inflows, if you look at all of last year, really were coming out of the US and then Canada. So this just shows you a little bit more of that growth. I think one of the things that I find interesting is if you look at the assets in actively managed strategies up until really 2022, the majority of the money was sitting in fixed income. Due to the conversions and people launching active strategies, we've seen that Dimensional Capital Group and others, JP Morgan, have been successful with actively managed ETFs on the equity side, and that has driven equity assets in actively managed strategies to surpass fixed income. I think that trend will continue, and we're seeing many of these firms look at coming to Europe. And with that, I have run out of time. So I hope this was interesting to talk about how and why ETFs are being used and why it makes sense to consider your clients, what strategies work for them, and how to best serve them. Thank you very much for including me today. Bye-bye.
Well, thank you so much for a brilliant session.